Ladies and gentlemen, the stock market crash that is happening right now, many people think this is the bottom, it won't get worse, we won't enter into a bear market, but people, this is my final warning, and in today's video, I'm going to go over why a bear market in the stock market is inevitable. There's absolutely so much happening in the markets right now, so many signals, so many indicators, so much news to break down. We got a lot of information. This is going to be a good one. You're definitely not going to want to miss this. So let's not waste any time. Let's get straight into it. Okay, so first things first, what we need to talk about, everyone, is the European markets are absolutely getting smashed. The DAX, this is the Germans market, that was down 4.4% yesterday. And what caused a lot of this fear in the markets and the reason why the European markets are crashing right now is because Russia just seized the biggest nuclear power plant in Europe. If we also look at the European Stock 600, this is kind of like the S&P 500 for Europe. That is also down 3.5%. But most of my viewers are in the US and Australia, so don't worry. I'll go over exactly what this means for us as well. Because this is what's happening now, everyone. Brent crude oil has just hit a new 52-week high of $118 per barrel. And people, I can't stress enough how much of an effect oil has on the markets. Because an increase in oil prices lowers the expectations of economic growth. It increases inflation expectations, and higher oil prices leading to a weakening economy will lead to lower company earnings and then lead to lower stock prices. Now, if you think I'm wrong and you think now is a great time to buy the dip, you can get up to 5 free stocks with Moomoo worth all the way up to $3,500. I'll put a link in the description and a pinned comment. We're also seeing Bitcoin get absolutely hammered today as well, down 6%. And this is why I was telling people, look, don't FOMO in after this short squeeze that made it skyrocket to $44,000 and $45,000. And if we look at the US markets, the Dow was down about 0.5%, S&P down 0.8%, and the Nasdaq was down about 1.6% as well. But the reason why I think the US stock market hasn't been collapsing as much as Europe is because what I think hedge funds are taking money out of Europe and they're putting it into the US because it's a so-called safe haven. But again, going back to my point of this video, this stock market crash is only just getting started. And let me show you some indicators and reasons why. Because of this, everyone, history suggests oil shock raises probability of a US recession. When oil rises 50% above trend, a recession follows. And I don't know about you, but I'm definitely starting to feel it at the pump here in Australia. Petrol is almost $2 Australian per litre. In the US, I'm seeing places like California and San Francisco, they're saying gas has hit over $5 a gallon already. Because look at this chart, everyone. Surge in energy prices suggests high probability of recession. We can see here, it happened in 1970, 75, 80, 90, 2000, and 2008. But what we learn from history is we don't learn anything from history. This time's different. It won't happen now. But it's not just surging oil prices and gas prices that is hurting consumers right now. Look at this. Food prices climbed to record as the Ukrainian war roils trade. An index of food costs increased almost 4% last month. Crop prices spiked much higher in recent days on supply fears. And I bring up another great chart. We can see here how it has now surpassed the last record high in 2010 and 2011. Listen to this, everyone. A United Nations index of costs was already near a peak in 2011 before the war disrupted exports out of the Black Sea region that's known as the world's breadbasket. Since then, grain and vegetable oil prices have rocketed to fresh records or multi-year highs, applying more inflationary pressure on consumers and governments and threatening to worsen a global hunger crisis. This is absolutely devastating what is going on right now, everyone. Consumers, the middle class, was already getting absolutely smashed and devastated from high consumer prices, but we're now seeing gas prices rise, fuel prices rise, food prices are at record highs, house prices absolutely skyrocketing. Can you see what is happening here? All the mandatory items, the essential items to survival, is skyrocketing out of control and is much higher than the CPI. Look at this. Russia and Ukraine play a crucial role in supplying food. Together they account for about a quarter of all wheat and barley shipments, a fifth of corn, and a bulk of sunflower oil. With big volumes of region supply shut off, buyers are having to hunt elsewhere. Though some imports are struggling to secure supplies in the face of higher prices and few cargo offers. And you can see the breakdown with this chart here. So what this means for the stock market is, or what I should say, what this really means for the Fed is, they're going to face much more inflationary pressures. So the Fed saying, look, we'll lift interest rates to 2% and that will bring down this, 7.5%, 8% inflation rate when we all know it's really minimum 15%. That is not even going to put a dent in inflation. And simply, I don't even think the Federal Reserve has the power to stop it, because what's behind a lot of this is the supply chain issues. They can't print money to fix that, or lifting interest rates won't fix the supply chain issues. And now what's really hitting inflation is this conflict with Russia and Ukraine. And though the markets are priced in the first 4 to 5 Federal Reserve rate hikes, I think they're going to have to go much higher. And like in 2018, where it wasn't until the Federal Reserve lifted interest rates above 2% we saw the market crashing, I think it won't crash during the first 5 or 6 rate hikes, but once we start getting over 2% interest rates, then we'll start to see more weakness in the markets. But that's the macroeconomic picture. Let's look at more specific indicators for the stock market, why it's overvalued, and it needs to come down much lower. Well, what have we been talking about a lot on the channel, everyone? I've been saying once you see margin debt start to fall, you're going to start to see the S&P start to fall. Now, margin debt has fallen 8.8% in January. We can see here margin debt is at all-time highs. The red line is margin debt, the blue line is the S&P. We can see here every time in 2000, in 2007, and 2018, when margin debt peaked and crashed, we also saw the stock market crash as well. And so what I think will happen once we start to see the indexes fall 20%, we're going to see more margin calls. But it's not just this, everyone. Look at this, the Shiller PE ratio. It is now 35. And if we look back at history, the only other time it was higher was during the dot-com bubble. And we can see here when it hit a really bad time in the Great Depression, we saw the crash. And we also saw when it got too elevated in 2008, we also saw a crash as well. Another indicator, the Warren Buffett indicator. This measures how much the stock market is worth to US GDP. And right now, the stock market is 192% of GDP, which by the current calculation says it's 48% above its historical average. And this is why we all need to pay attention, everyone. What's more worrisome is that the S&P 500 has declined at least 20% in each of the previous 4 instances where the Shiller PE surpassed 30. Wall Street simply doesn't have a good track record of supporting extreme valuations for long periods of time. And this is exactly what I've been trying to stress and trying to tell everyone on the channel. I've been saying, yes, the stock market is extremely overvalued. Yes, we're seeing a lot of euphoria in the markets, but these prices cannot be sustained for a prolonged period of time. And again, when we look back at history, every time the Shiller PE ratio goes above 30, we see a decline in the stock market of at least 20%. But I know what you're thinking. Okay, well, what does all this economic, macro, and stock market jargon mean for me in simple terms? What this means is higher oil prices is going to lead to a recession, and the Federal Reserve lifting interest rates is going to add more downward pressure on the economy, which will lead to recession. And this couldn't happen at the worst possible time, because even though we've had a recent sell-off in the stock market, valuations are still well above trend. So what are investors doing to protect themselves? Let's have a look. Well, everyone, what I've been telling you, if you want to protect your portfolio against a downturn, have a bit of gold in your portfolio. Gold is up 2% today to $1,974 an ounce, and it's looking like we could see $2,000 gold soon. We're also seeing silver have a great day today while all the markets are in the red. Silver is up 2.6% to 25.88 cents an ounce. Now, for some people, I don't personally invest in bonds, but what a lot of investors do and a lot of hedge funds do is they flock to the US 10-year Treasury yield, which is known as the safest out of all the safe haven assets. And this is why we're seeing the US 10-year Treasury yield plummet, because we're seeing a flock to safety. So that's what investors are doing, and that's what you can do to protect your portfolio during a downturn as well. So again, people, I'm being consistent, I'm being patient, I'm waiting for the S&P 500 to at least enter a bear market of a decline of 20 to 30% before I personally start buying in. I'm waiting for Bitcoin to go sub 30,000 to 25,000 to when I'll be happy going in. And I've been dollar cost averaging into gold since around 1700, 1750 to hedge against this downturn. So everyone, that's my thoughts and opinions of what's happening in the stock market right now. Some reasons why I think this downturn isn't over. But what do you think? Let me know. Now, for all my loyal viewers and subscribers still watching, you're awesome. If you think I'm wrong and now is a great time to buy the dip, you can buy the dip with Moomoo, worth all the way up to $3,500. I'll put a link in the description. Thanks for watching. I'll see you in the next video.